All right, sorry about the delay. We will get started now. So thank you for joining. We're going to talk a little bit about international diversification for income investing, which should be exciting. I can attempt to convince people that they should look for dividends in places you don't get franking credits. So I think I have my work cut out for me. But anyway, before we get into it, a couple housekeeping items. Anything you hear today will be general advice. I don't know anything about you, so I can't offer personal advice. If you're over in New Zealand, you can log on to our website, morningstar.com.au, for a copy of our VAP. And the New Zealand regulatory authorities would encourage you to speak to a financial advisor if you want personal advice. So this is the second in our series of income investing, second of 5. So we've got a couple more coming up in March. And as I said, we're going to talk about global diversification for income today. Any questions you guys have, send them through. I think today should be shorter, so there'll be more time for questions. I didn't get to them all last Tuesday. Everything, of course, will be recorded. We'll have it up on YouTube in a couple days. So if you have questions that I don't get to today, or you want a copy of previous editions of this, just email me at mark.lamonica1@morningstar.com. It is the email address that is on the invite for this webinar. All right, so why don't we get started? So we are going to talk today about diversification and why potentially you can diversify by getting some of your income needs met by global shares. We'll focus kind of specifically on individual shares today. We have done a session in the past last month where we talked about ETFs, including our analyst's favorite ETF, which is Vanguard's high yield ETF with the ticker symbol VHY. Not going to really spend any time on that today, but one of the big things that we did talk about last week, and we'll obviously mention a lot today, is one of the reasons when you are building an income portfolio that you do want to look overseas is that diversification effect. So of course, if we are building a portfolio where we're trying to generate income and trying to use that to support our lives, we of course don't want that income to drop significantly. And that's why we diversify in all of investing. But it's also important to take that into account with income investing. So I just pulled a quote off of Money Smart that talks about why we want to diversify. And what we're talking about in this quote is really looking at an overall portfolio just from an asset perspective, but the same holds true with income. So of course, we want to, as I said before, generate income that can hopefully pay for our life at some point. And as this quote says, different asset classes do well at different times. Now is not a time that you want to be invested in a bunch of mid-tier banks in the US, for example. Not a time when they're doing well. And basically, if a business or a sector, and we'll talk a lot about sector today, does really badly or actually fails, you of course won't lose all your money. So in our context, if we have trouble in a sector, trouble with a specific company that leads to a dividend cut, we will of course not lose a huge part of our income. And what we're really talking about today is we are talking about, we're getting some strange messages. Anyway, keep sending them through in the chat. I'll try to figure out what they mean. So when we're talking about diversification, really what we're trying to do is we're trying to get rid of that single security or single sector risk. That's, of course, why we build a diversified portfolio. And one of the problems, as we'll get into with Australia, the Australian market is very concentrated. So while there are certainly benefits from investing domestically for dividends, and in no way are we saying you shouldn't do that, and that benefit is franking credits, and that benefit is generally a higher yield that's paid in Australia because investors like dividends and because of the impact of franking credits, we also can get some benefits from investing overseas. All right, so what are we looking for? Well, there's a couple different things why we might want to invest globally. So as I said, we'll get into both of these, it's diversifying your sector exposure. So in Australia, as we'll see in a subsequent slide, getting a lot of our dividends really from two different sectors: financial services, of course, including all the big four banks, and then, of course, materials, where we have the miners. We'll talk specifically about each one of those sectors and things that potentially can go wrong in them, but it's harder to access income from other sectors. The other thing is that if you are investing in US shares, you do get more dividend payments a year. So typically a US share will pay dividends quarterly. Some people do like this because it smooths out income over the course of the year. And there's also a slight compounding effect involved. It's not that big, but over years, that can benefit if you're doing a dividend reinvestment plan. So we'll go into each one of these and go and elaborate a little bit on them, and certainly keep sending the questions through. All right, so I played around in Excel today. Sorry, this chart has a lot on it, but basically what I took is I took the ASX 20, so the top 20 largest shares in Australia. Now, the Australian market is very concentrated, as I said, between sectors, but it's also very concentrated in terms of allocation to the biggest shares. So if we go and we look, and we did this exercise a couple of weeks ago, if we go and look at how much of something like the ASX 200 or 300 is allocated to the top 10% of shares, it is higher than in a lot of other markets. So there's a lot of concentration in some of the biggest companies in Australia. So of course, this is when we're taking a market cap weighted view of the world, but that is what most indexes do, and most ETFs and funds that track those indexes take a similar approach, where bigger companies, of course, get more allocated to them than smaller companies. So what you can see here very quickly, these are the top 20 names in Australia, so the ASX 20, and this is a weighting. Now that weighting is based on the top 20. It's not based on the overall 200 or 300 index. But remember, a lot of that is allocated to these shares. And what we can see here with BHP, that has almost 17% of this ASX top 20. If we go back and we look at BHP with a wider index, whether that's a 2 or 300, you're still putting about 10%, a little north of 10% into BHP. So while those percentages are certainly exaggerated when we just look at the ASX 20, they're also very high when we look at the overall indexes as well. So very simply what I did here, and hopefully this will make sense in a second, I imagine that you invested $10,000 into the ASX 20, and then, of course, looked at how much of that would be allocated to each one of the shares of the top 20. So you can go out and buy an ASX 20 ETF if you want to invest passively in it. So basically, it's kind of replicating that experience of putting $10,000 into it. So got a price, and basically that determines how many shares that you're going to purchase. And if anyone's looked at the market today, those prices are a little bit lower. Aussie market, last time I checked, was down around 2% with some of the Silicon Valley Bank fallout. But either way, what we're looking at here is the dividend in the last 12 months that was paid. And that, of course, shows you how much you would make off of each one of these positions. So the very good news, and one of the very good things about investing in Australia for income, is there's a high dividend yield. So you'd see if you put $10,000 into the ASX 200, you get $508 in dividends. So we've got about, if we round up, a 5.09% yield. And then you can see franking as well. So franking, obviously, and this is just looking at the last year, we see the franking percentages on those dividends. So lots of 100 on there, which obviously benefits investors a lot. And what I did is I broke this down into the different sectors. I remember this is the top 20, but still very representative of the overall index. So what you'll see, if you look at financials and materials, you're getting a lot of your dividends from those two sectors. And we'll talk about those in a second. You include energy in there, another meaningful position. And then basically you're getting very little from the rest of the sectors, including 0% from utilities or from technology. So when we're talking about diversifying, what we're talking about is getting exposure to those different sectors and really spreading out your income among lots of different sectors that will perform differently based on economic conditions. And then finally, we do have a Morningstar Dividend Index, which I'll be talking about later. This is a US index, but I just put in the number, and there are 75 holdings in it. I just put in the number of companies that fall within each one of these sectors as we go through it. You'll see there's 0 in real estate, and that is deliberate. So actually, real estate has been cut out of that index. So this doesn't really apply to Australian investors, but the reason that was done is because there's actually a different tax rate on dividends that are received from a real estate investment trust versus a dividend that is received from a regular company in the US. And so because of that, that was excluded. But what you can see is there's certainly opportunities in these individual names in here in some sectors that are underrepresented in Australia. So let's talk about the two sectors that make up a lot of the Australian index, and things that could go wrong. I am not saying they will go wrong, but things that certainly could go wrong that could impact those dividends that you're getting paid. So now we start with materials. So materials is the largest. I put this in the right order. Materials is the largest with close to 40% of the income of the ASX 200. So materials, of course, are the miners and very much reliant on China. So what could go wrong, of course, is that if the Chinese scale back on construction, where a lot of these materials go into, iron ore is kind of a classic example. If they scale back, or if they start sourcing because of geopolitical issues, if they start sourcing those materials from different countries and different providers, that of course could be a problem. And if you want to see an example of this, and it's a little bit of an extreme example, but if anyone goes back and looks at Treasury Wine Estates, so they are the owner of Penfolds among other brands, they basically went to zero in terms of exports into China, and that was because of a tariff put on. So you're obviously putting a lot of weight into China. China aside, and although China does drive a lot of the demand, that of course is a huge driver of the prices you're going to get on these different materials. The other thing, of course, is price fluctuations with those commodities that they're mining and selling. And materials traditionally has been a very cyclical sector, which basically means that as the economy goes through different cycles, it's going to impact these materials companies because it's going to impact the demand for the commodities that they're going to sell. So that's another thing. And cyclicality is something, if we're trying to build a steady stream and a consistent stream of income, if we're trying to replace our paycheck, for example, by income generated from our portfolio, that cyclicality can be a problem. And it can be a problem, of course, because when prices fall, dividends are generally cut. And if you go back and you look at a lot of the large miners, you can see there's a lot of variation over the years with their dividends. And we've been in a good spell right now. So we're getting very high dividends from some of these major miners. Some of them are starting to get cut, but particularly kind of last year and the year before, we had very, very good dividends. We had special dividends as well. But once again, we are at risk from over-relying on that sector if prices of commodities like iron ore fall. And which is something, by the way, that over the medium term, our analysts do expect to happen. They do expect things like iron ore to pull back. The other one is, of course, financials. And there's a couple different risks with financials. Now, banks, as we're all reading about in the news right now with what's happening in the US, banks are a lot more complicated, and financials in general are a lot more complicated than when we look at simpler businesses. And we'll spend some time talking about simple businesses and non-cyclical businesses later. But really, the big thing, of course, is changes in the level of interest rates. Now, generally, when interest rates go up, banks actually do okay because they're able to expand that margin, that net interest margin they make. the difference between what they pay for deposits and what they're actually lending money out for. But once again, banks can also be cyclical because they are reliant on loan growth. So what do you need for loan growth? Well, you of course need confidence from consumers, confidence from businesses to go out there and borrow money and invest it in a new project. And of course, particularly with the Aussie banks, you have a huge exposure to the real estate market. So, quite simply, the banks over the years, more and more of the income that they're generating is from mortgages. More of their loan books are from mortgages. And there's all sorts of things that can impact that. So of course, number one, obviously housing price levels. And very simply, if we don't even talk about any sort of consumer distress around rising mortgage rates, if we do see housing prices come down and we do see less turnover in the housing market, it means they're writing less loans. And we've seen a lot of competition. So one of the things that's really held back that net interest margin expansion has been a lot of pricing competition among the big four and all sorts of banks in Australia to try to keep and win mortgage customers, particularly as people are starting to refinance. So just something to think about. Energy, really, we'll just touch on energy. Very similar to materials, certainly less reliance on one country as we get with a lot of the materials in China. But once again, very, very cyclical from an energy perspective. And we've seen that. If we would have gone back and looked at this same dividend percentage a couple of years ago, if we went back to 2020, where the demand for oil and natural gas fell significantly and prices fell significantly during COVID, the dividends, of course, were not as high. And we've seen sort of surging with the increase in energy prices, we've seen surging dividends from a lot of the players in there. So just something to think about as you're going through here, but it does present the opportunity, of course, to diversify those income streams by looking overseas. All right, so this chart right here, and I will admit that, at the end of the day, this difference is fairly minimal when we are looking at the impact from franking credits, which is very positive. But really what I took is I took a 5% yielding share is $100, holding 100 shares, that gives you $500 in income. And what I looked at is the impact that you get from a compounding perspective from a dividend reinvestment plan. So a dividend reinvestment plan, of course, is when you are going out there and instead of receiving your dividend in cash, that cash is actually used to buy shares. And this is one way, and we talked about this last week, this is one way that you can really grow the amount of income generated by your portfolio, because of course, over time, you get more and more and more shares. More shares multiplied by a dividend gives you more income. So if you're trying to build an income portfolio and you have a while to do it, a dividend reinvestment plan can turbocharge this. Now, you do get the same effect. It's not as easy to model, of course, but you do get the same effect, of course, if you just take those dividends in cash, then reinvest them yourself. But what we're looking at is the impact of quarterly dividends. So but basically the difference is 4 times a year, instead of 2 times a year, you are going to increase your share count. So I just assume that the share price would go up 8% a year because they don't generally stay static and spread evenly across the quarter. So of course that's an assumption. Would not happen in real life quite that way, but if we do have raising security prices, it means you get to buy less of those shares from a dividend. And basically you see there is a little bit of a difference here. And the difference basically means all things being equal, no increase in the dividend. You are increasing your income by 4.95% versus 4.87%. So as I said, very small. When we look at this over 30 years, we look over a long time frame, and this doesn't even account for all the compounding. We can see there's a difference. So it's probably not a reason to rush out there and buy what are generally lower yielding US shares than Australian shares, but it does provide a little bit of a difference. And some people do like more frequent dividends. because it works well with their financial plan. All right, so got a couple questions. I'll pause before we go into the next section and try to get through these. So Anthony's got a question. If you go down the global route, do ETF managers typically hedge for currency fluctuations? If not, what steps, precautions should investors take to allow for Forex, so basically changes in exchange rates? All right, so it's a good question. ETF managers and fund managers do not typically hedge for currency. So what that means is that a hedge, of course, is basically using derivatives to make sure there is no currency impact from investments overseas. So typically they do not, but it's become increasingly popular that another version of a fund or an ETF is released that is a hedged version. And that hedge is removing a risk. The risk it's removing is the risk of currency exposure. So very simply, if you are an Australian investor and you are investing overseas, you want the Australian dollar to go down. So you want the Australian dollar to get weaker against those currencies. So when you are paid that dividend overseas, it's worth more when you translate that back to Australian dollars. So currency is something that, well, some people spend a lot of time trying to predict where it goes, but it is a little bit tricky, of course, to predict where currency is going to go, as it's tricky to predict where anything's going to go. So the real question is, if you take that hedged route or don't take that hedged route, the question for you, of course, is how is this going to impact your life? So what you're going to get if you invest and you're trying to build this income stream and you don't hedge that currency risk, what you're going to get is a lot of fluctuations. So you will get fluctuations in the amount of income you're receiving overseas, especially as those are translated back into Aussie dollars. So that is going to impact you. So the question really is, what does that variability in an income stream mean to you? So if it is something where you are trying to live off of these dividends and you want a very predictable income stream, that's where you really want to go out there and find that hedged version of an ETF or fund. If, however, and I use this example all the time, maybe just I like it, but if, however, you sit there and you look at your spending and you are retired, for instance, and you plan on traveling a lot and spending money overseas and are taking an annual trip or more, then perhaps you don't want to hedge that. And the reason for that is because, of course, as an investor, it's really, really good for me when the Aussie dollar falls in value. As a traveler, it's really, really bad because, of course, when I take those Australian dollars, let's say I'm traveling to the US, when I take those Australian dollars to the US and want to go buy something, everything costs a lot more. So I think it's really looking at your life circumstances, looking at the amount you have allocated overseas, trying to figure out, okay, how can I actually do that? Because the increases in those dividends from a currency perspective will offset some of your spending increases if you do plan on going overseas. So hopefully that answered your question, Anthony. Rodney's saying, I don't think there is an ASX 20. I'm forgetting the ticker symbol now, but there is one because I looked it up. It's a BlackRock product. So there is an ASX 20 ETF. So I do know that because I was looking at it. Maria says, can I have a copy of these slides? Of course, just send me an email and I will send the slides. Anthony says, an alternative, is it worthwhile looking at small caps for income, or is this too risky? Does such a fund exist? Yeah, so let's talk, and we'll talk a little bit about diversification. So because of the topic of today, I am focusing on investing overseas versus investing in Australia as a point of comparison, but just saying that, hey, it could be good to diversify overseas. ILC is the ticker. There you go, Rodney. I knew I remembered that. That's the ASX 20 ETF. Yes, you should diversify widely with income. And so you can look at all sorts of things. We're talking about sectors and we're talking about countries right now, but also we want to diversify potentially between different size companies. The one thing I would say about small caps, when you compare them to large caps, is in many cases, small caps either won't pay dividends. A small cap is a small company. And that doesn't necessarily, being a small company doesn't necessarily mean you have to be a new company, but a lot of them are still in the growth stages. So the problem with small caps is it's sometimes harder to find yield there. So basically find that income there, because when a company is still growing, what they're typically doing is they're reinvesting a lot of their profits into the growth of that company. And of course, if they're doing that, they're not going to give them to you. And then when you have these larger companies that have larger market share, they don't have as many growth opportunities because the company is so big. So what do? They typically give that money back to you. So you are getting higher dividend yields. So just something to think about. Okay, I'll pause with questions, but I'll get back to them. We've got. Let me just, there's a couple more. And I don't know what this bot thing, Jerry says a bot is taking meeting notes, which is scary. Anyway, thank you for that. Sorry, a couple more that are on this topic, and then I'll get back to the other ones. So Michael says it's not possible to exactly currency hedge an equity as the cash flows are unknown. Currency hedge a bond because all of the cash flows are known. Yeah, so that is true. So what I'm talking about from a hedging perspective is I'm really talking about ETFs. So it's not directly, it's very difficult for you to hedge something on your own if you're going out there and buying individual shares. So that is, that's, I guess, the issue that I was talking about. And then Grant says, from my analysis, U.S. dividends seem low in comparison to EU dividends, even lower when franking credits are taken into account. Absolutely. So if you go and you look at, so we looked at that ASX 20 example where the yield was over 5. The yield on the S&P 500, which is the 500 largest companies in the US, is below 2%. So it's somewhere around 1.9. So that is absolutely true, that overall US shares yield a lot less than Australian shares. There's a couple different reasons for this. Number one is franking credits. And I showed a chart last week that looked at the payout rate, or how much a company pays out of their earnings. And Australia and the US were pretty similar until franking credits got introduced. And basically franking credits, of course, Australian investors like dividends more than US investors. I'm speaking in generalizations here. And of course, companies are catering to that. So because of the benefit of franking credits, we did see a divergence between those two things, where Australian companies are paying out a lot more of their earnings in dividends, trying to cater to that investor desire for dividends. In the US, buybacks are much more popular. So buybacks are, of course, another way that companies can return capital to investors, and they're just more popular in the US. Because there is tax efficiency about the way that happens. So yeah, there is certainly a difference, but there are certainly companies in the US and elsewhere that do pay high dividends. It's just the overall kind of yield that you're going to get from being a passive investor in a large index is going to be less. All right, so we're going to take a look at a couple companies, and really the reason we're going to do this is to kind of go through some different things you can look at with international companies or with domestic companies. I use two international examples and use two examples that are pretty underrepresented in the Australian index. And I got these two off of the Morningstar Dividend Yield Focus Index. So what this looks to do is it looks at US companies, so these are only US companies, and it sets a certain amount of criteria involved for what's going to go in there. And what the criteria is trying to look for are companies that do have sustainable dividends. That's what we're always looking for as income investors. We're looking for the sustainability of that dividend. So what they do is they look at the 75 highest yielding shares with a wide or narrow economic moat. And I'll talk about why this stuff matters. Low, medium, or high uncertainty. And those are the three bottom uncertainty levels in our rating, which I'll talk about in a second. And then we're looking at finances. So we're looking at, is the company in a strong enough financial position to continue to pay dividends? And they're using something called distance to default, but I'll go through a couple things that you can look for as well. So we'll go through these two companies. So Cisco is a technology company. So it was one of the kind of .com darlings, but they transformed the company a lot and actually concentrate on paying dividends now. So Cisco basically builds all the plumbing of the internet. So the routers and switches and all the other stuff that basically goes in, and a lot of it now is done on the cloud. But anyway, Cisco builds the plumbing of the internet. So you can see current yield that isn't high by Australian standards, but is pretty high from a US perspective. But you've seen really strong dividend growth. So one thing we want to see as income investors is not just sustainability, but also growth, because it's a really good way for us to grow our income. And we talked about last week sort of the trade-off between growth and higher yield, but you see Cisco has had very strong growth. Talk about economic moat for a second. Now, economic moat, of course, is our analysts going in there and assessing the sustainability of the competitive advantage that a company has. And we rate companies with no moat, wide moat, and then, of course, narrow moat. So narrow moat means 10 years or more of that sustainable competitive advantage, holding those competitors at bay, which is what we want from companies, and wide moat is 20 years or more. So why do we want to look at moat in terms of dividends? Well, we do have to remember always that dividends, of course, are a company paying off a portion of their profits to shareholders. So it's very important that that company continues to make profits. And it's very important that that company hopefully grows those profits and invests in itself, invests in its growth profitably. So that's why moat is very, very important. So what it can do is it can give us a bit of a, I guess, preview of a company's ability to continue to maintain their market share, maintain their margins, all the things that are really important to make profits. That's why we want to look at economic moat. Uncertainty, so probably a very misunderstood rating by our analysts, but uncertainty is basically looking at a company and how much business risk is involved. So I give this example a lot, but very quickly, not all companies have the same levels of business risk. So it just makes sense, right? If we look at business intuitively, some companies are more risky. They're more risky because they're in bad financial shape. They're more risky because maybe they are serving a market that's very cyclical. They're more risky because they're smaller. There's all sorts of reasons why a company can be very risky. And the uncertainty rating is our analyst's assessment of how risky that company is. So there are 5 different ratings on there. So we're really looking at, remember for this index, we're looking at the 3 bottom. And if a company is less risky, there's less of a risk, of course, that something's going to happen to the cash flows that they're generating or the company in general. And the less business risk that a company has also potentially indicates how sustainable that dividend is. So yeah, the example I always use is, Coca-Cola, huge company, multiple products, sells everything globally, good financial shape, and we compare that to a very small company, maybe sells one product, maybe that product hasn't gained market share or hasn't caught on yet with consumers. So maybe that small company, is a bit of a lottery ticket that could do very, very well, but that big company is going to be better able to maintain those dividends. I just put in the star rating. So the star rating, of course, equates to price. And what we're looking for there is the higher the star rating, 5 is the highest. We're looking for the difference between what our analysts believe it's worth and what the company is actually trading for. So not directly related to dividends, but hey, you might as well buy a cheap company anyway, because a lot of us are looking for capital growth as well. Payout rate. So the payout rate is, as I said before, it's the percentage of earnings that are paid out as dividends. So the higher that payout rate is, the less profits need to fall for the dividend to be cut. Now, companies can obviously hold on for a couple of years generally and figure out ways to keep paying dividends and not cut the dividends. But ultimately, over the long term, it's really they need to continue to make profits, hopefully continue to grow those profits in order to pay out a dividend to shareholders and hopefully grow those dividends as well. So the lower the payout rate, the lower the percentage that they are paying out as a dividend, the safer that dividend is. So technically right here, Cisco at 55%, Pfizer much lower at under 30%. Technically, they could have their earnings drop by 40%, and then hopefully we'll still be able to maintain that dividend. Now, obviously, nobody wants that to happen, but at the same time, that shows on the downside what the risk is. And on the upside, it shows that the company can potentially keep increasing that dividend just by upping that payout rate. Now, a lot of companies will talk about the payout rate. If you go and you read reports from management, annual reports, they'll talk about that payout rate, and they'll talk about how they're trying to maintain a payout rate between certain percentages. And that can be an indication, number one, of how serious management is about a dividend, but also can give you a clue saying, okay, if you're going to pay out 75% of your profits as dividends, when you start thinking about that company's profitability, then of course you can hopefully see where that dividend will land, particularly in those very cyclical industries, right? So if you go to a miner and BHP, for example, says they want to pay out a certain percentage of dividends, and the cyclicality takes down their earnings, you're going to see that dividend get cut, which is what we see a lot. Debt to equity. So we talked about financials and how we want a company to be in strong financial position in order to maintain that dividend. That makes sense, right? Just like if you were lending money and you had two different mates you could lend your money to, well, you're probably going to lend your money or feel better about lending your money to the person in better financial position because they're more likely to be able to pay you back. So we do want to look at things like debt ratios. We do want to look at how much debt overall just that company has. And so debt to equity is a measure that we use a lot to compare debt levels from different companies, because we're not just looking at a dollar amount of debt, they owe $1 billion. We're comparing that to the equity in the company as well. So both of these, I will say, both Pfizer and Cisco are very, very low. So we're at less than 1% here. And debt to equity can vary significantly between different types of businesses. So really what I would look at there is I compare it to other companies in that sector and compare it to the average debt to equity in that sector. Some companies just naturally can take on more debt because of their business model. But these are both extremely low, by the way. So not much of a concern about debt. If we're also worried about financials, and I just picked a different ratio here, I think it's a pretty good one, but the interest coverage ratio. So basically what that's looking at is how much is the company making and how much do they actually have to pay off to service that debt. So both of these companies are in very good shape here as well, right? So if they're making 37 times the amount of interest that they have to pay to service their debt, well, they're in really good shape. Because what you don't want to see is a dividend investors for a company to be forced to cut it. And one way you are forced to cut it is, remember, a dividend is a choice. Management decides if they're going to pay a dividend. Paying back your debt is not a choice, unless you consider it a choice to go bankrupt. So they have to pay back their debt. And if there is a very, very high or very, very low interest coverage rate, it means that a lot of their earnings could be taken up just by interest to service that debt. And I guarantee they will cut the dividend because they're basically legally required to. There's a lot of covenants in place from banks and bondholders and different lenders actually force companies to cut dividends if they get in poor financial condition, because the bondholders want to get paid back. So something to think about here. Pfizer, I won't spend too much time on Pfizer. I think everyone's probably heard of Pfizer at this point or got multiple jabs from Pfizer, but of course they are a global healthcare company. So another thing that's pretty underrepresented when we look at Aussie indexes, higher dividend yield, lower growth. in terms of that dividend. But once again, kind of checking all the boxes as we go down here. So the payout rate's a lot lower, very low debt to equity, still really good interest coverage. So just a couple of things we want to look at when we're going in there and evaluating companies. All right, so got some more questions that we'll go through. All right, so we've got a question. Is there an ETF for basically what Jenny's talking about is the S&P Dividend Aristocrats. So basically what the Dividend Aristocrats is talking about is it is talking about companies that have raised their dividends, I believe, for the last 25 years. So American companies that have raised their dividends for the past 25 years. They have done very well. So I talked about a Merrill Lynch study that went out there that showed investing in these companies, you got a higher return and you got lower volatility. So basically a lower standard deviation. They bounce around less in price. That is something that's not supposed to happen in investing. So investing theory tells us that the more something bounces around in price, the lower the returns would be. Cash is a perfect example. Cash does not, as long as we're looking in nominal terms and not inflation, cash does not bounce around in price at all, and you get a really low return on it. Whereas shares bounce around a lot, you get a higher return. So there is an ETF for the Dividend Aristocrats. There's not an Australian listed version of that ETF. So I don't remember the ticker symbol, but if you send me an email, Jenny, I will look that up for you. But it is a US ETF, and there's shockingly, I think there's an Israeli one as well. But yeah, there is an ETF that tracks the Dividend Aristocrats. All right, so we've got a question. Given the focus on franking credits and their importance for income seekers, as much as it pains me to ask this, are Australians facing self-sovereign risk considering the posturing of the federal government on franking credits and superannuation? Supposed to be a global trend as governments try to repair debt. What can investors do to safeguard against this? Okay, so let me talk a little bit about, well, franking credits and things we've seen. So obviously, I'm not going to speculate on what the government has done. We obviously famously saw what happened when it was proposed previously in the previous election to get rid of franking credits, but I don't know. So obviously with tax rates, with superannuation, with franking credits, these are choices made by the government. They are not in some constitution. And of course they can change. And I think as investors, we are always going to face changing government policies. Now, in terms of preparing for it, there isn't a whole lot we can do, obviously, other than remain diversified, other than looking for potentially sources of income that don't have franking credits. The real interesting thing about franking credits, other than what will happen on a personal level, so if this is something that you are, if this is something, of course, that you are using to fund your lifestyle, fund your life, maybe lifestyle is the wrong word, your life, then yes, franking credits are going to be a problem if they go away. The interesting effect, of course, would be to see overall what they would do to the market. Now, we did see a giant increase in franking, or we did see a giant increase in the amount that's paid out to shareholders because of franking credits when they were introduced. But we would have to see if the reverse happens. So potentially Australia could revert, or not revert, but could move back in line with the model that we're seeing in the US, where more money goes to things like buybacks, and there's different ways to return money to shareholders. Yeah, I don't know. So I think, it's hard to prepare for an event like that. But yeah, that can certainly happen. So we've got a question from Eric. Does Morningstar assess the form of debt as the interest coverage ratio only measures the ability to cover current debt? Yeah, so in the environment of rapidly increasing interest rates, the coverage ratio could change relatively quickly. Yeah, so I think there's a lot more that you can go in there and assess when looking at debt levels for a company. So what is the mix that a company has? So whether they have floating rate debt, which would increase as interest rates go up, or they have fixed rate debt. The other thing, of course, if we're looking at overall debt levels, we want to look at the maturity schedule, because of course, if a company has to roll over debt, even if they have fixed rate debt and they have to pay it off, typically a company would go out there and they would, of course, borrow more money. And that can be a problem in a interest rate environment where they're going up, because of course they'd have to pay more. So what I would say, the interest coverage ratio is one thing to look at, but there are other things you need to look at as well. Anything kind of around debt. And what we want to see overall of a company is we do want to see a company. I will get to the Q&A questions, by the way, in a second. Sorry, I was just doing, the chat questions in a second. I was just looking at the Q&A one. So we want to look at the overall debt levels of company. We want to see when it's maturing. We want to see the type of debt it is. And all of this is listed in the annual report. And this is all stuff that our analysts look at. So if you go down in the capital allocation section of our report, if they see any problems with debt levels, that's where it's going to come up. All right, so let's see what's going on in the webinar chat. I saw a lot of, because it's flashing on the screen up here, I'm not able to read them all. I see a lot of World War III talk. So I don't know if I can answer questions on World War III. Okay, so John saying, how do dividends at 5% pay twice a year compare the same money in a 5% savings account that pays monthly? So very simply, and I see there's a couple answers in there, very simply, that 5% a year in your savings account will be better than 5% dividends, because you'll compound that monthly. So basically what that means is the bank will pay you every month. You'll have more money. You'll have more money to earn the interest the next month. But as was pointed out by Phil, is that that's looking at things very simplistically by just simply looking at what you are going to get with that 5% from an income perspective. Shares offer the opportunity, yes, capital growth, as Phil said. The other thing is you have the opportunity for that dividend to, of course, increase. And so over time, as that dividend increases, that can be very, very beneficial for you as well. And a couple of people pointed that out, Phil and Rodney pointed that out. So John saying, sure, I was comparing income returns. That was a key focus, capital growth. Okay, yeah, the income, like think about the compounding effect of getting something monthly. Like getting a monthly dividend is better than getting a dividend twice annually. So you do get that compounding effect over the years. So if you're purely looking at that standpoint, that 5% would be better earning it that way. But obviously all sorts of other things that happen with shares. The other big thing that I would look at, the difference, and we're sort of facing this right now, the difference between simply a term deposit, for example, and shares is shares, hopefully, companies hopefully should be able to pass on at least part of the impact of inflation, which you're never going to get if you're just looking at cash. So yeah, something to think about that there. Now, obviously, some companies can do that better than others. We saw a lot of margin compression in the last earnings reports that we just had in February. So those sort of early ability to pass on price increases. After a while, consumers get fatigued and actually figure out what's happening and change their behavior. But yeah, that's another advantage. All right. What happens if World War III occurs? Coca-Cola thrived by supplying both sides last time, but this one is going to make that impossible with nukes. Yes, I agree that if you get nuked, you probably won't want a Coke. But yeah, I don't I don't know how to talk about World War III, but here's hoping it doesn't happen. Smith & Wesson, yeah, well, might need something bigger than a Smith & Wesson against a nuke. Oh, sorry. All right, what are my thoughts? Sorry, I was going through a couple of these questions. What are my thoughts? Buybacks versus dividends. Well, let's talk about the difference. So the theory behind buybacks and why a lot of people really like buybacks is that it is a non-taxable event for you. I'll talk about sort of what this means in a second, but basically if we think about a buyback, companies going out there, they're purchasing shares. If they're doing that just on the market, then you, of course, have the choice whether you want to sell your shares or not. If you don't sell them, then of course, the share count should drop. And I talked about this last week. It doesn't always, because sometimes companies use that to cover up basically dilution from giving shares away to employees a lot of time and options, issuing more shares so they can go out there and purchase another business. But all things being equal, a buyback will reduce the amount of shares that are out there, and it increases your share of the profits of that company as an owner. So it is a non-taxable event as long as you do not choose to sell your shares. So that's why kind of academically a buyback is generally preferred over paying dividends. Dividends, of course, I have no choice. I get a dividend. There is a taxable event when that dividend comes into me. So yes, that is sort of the theory around buybacks versus dividends. The one thing that I guess I would say about this is that, yeah, looking at them in practice, often it's a lot of money going out there for buybacks. You're not actually seeing that impact. So that can be a problem if you look at actual share levels. They're not clean as they appear to be. And also, I think dividends there's a lot more pressure on management to not cut dividends because it's so visible, where people basically buybacks generally will have a certain amount of money allocated to them. They'll run for a certain amount of time. And so there is really nothing to cut. Management can decide to re-up that buyback, but it generally has less of an impact than dividends. So there's some discipline there's some discipline that is placed on companies by dividends. All right, so Emma's saying, sorry, I joined late. Should we buy Cisco or Pfizer? I would just say Cisco and Pfizer are both shares that our analysts believe are attractive. Whether you should buy it or not is, of course, up to your own personal circumstances. So we've got questions about 5% capital growth and 4% income, preferably fully franked. So I mean, we do have certainly screeners where you can go in there and look at income. You can look in the past at the capital growth you're going to get. The only thing I would say is, of course, that is the past. We want to look forward, so both dividends and capital growth could be very different in the future. But yeah, something you can look at. Okay, debt to equity. So Linda's saying, does debt to equity mean the percentage of earnings to pay off the debt, or the percentage of the total value of companies? Looking at basically the balance sheet. It's looking at what's in the shareholders' equity section and what's in the debt section. So it's not a percentage of earnings to pay off debt, but what we're looking at is the capital structure of the company. So some companies that have a ton of debt, where you're getting really, really high debt to equity, could be a concern that they've taken on too much debt. All right, so I've got one more slide to go through. Let's see if we have anything else. Oh. Okay, so the rule 72. Anthony says, I wonder if you could explain the rule 72, where you can calculate double and having your capital based on interest inflation rate. Okay, so basically the rule 72 is very simply that if you want to figure out how or what percentage, how long it will take for you to double anything. So whether you are doubling your income, whether you are doubling your investment, all you do is you take the percentage of growth per year and you divide it by 72. So it is a nice little rule, right? That if you can grow something by 10% a year, you divide 72 by 10. That means you will double. If we're talking about your portfolio, if you can grow your portfolio by 10% a year, you will double the portfolio in around 7.2 years. So that is a really useful rule that can give you kind of back of the envelope calculations of what the impact would be, of a certain growth percentage. All right, so I'm going to go through my last slide. It's about tax, which is exciting, just because we always have these questions. And then I'll get into any remaining questions, although we only have 5 minutes left. All right, so let's talk about the tax implication of global dividends. So one thing that people generally worry about is, of course, what are the tax impacts going to be? So very simply, if you're going out there and you're investing directly in a company, you are likely going to owe tax in that country. Now, you don't have to file taxes in that country. Some companies, as this paragraph explains, will do an automatic withholding. So basically what that means is that when you get paid that dividend in the US standpoint, they will take 15% of that away from you. That 15% is the dividend tax in the US for most people. So the US government will take that immediately out of the dividend. You get $100, they'll take 15 of it. You've got 85 left, but it is a credit. You will still owe taxes on dividends that are earned overseas from or to the Australian government. And that 15% that you have paid to the US in this example will simply write off on your taxes here. So you'll get a credit for that. So investing in overseas does not mean you are paying more tax. It just means it's a little bit complicated with the way that it actually works. If you are using a fund or ETF, it's a little bit easier because you don't have to pay the tax on every single holding in that fund or ETF. It will all be summed up for you, and you will receive this attribution MIT, Managed Investment Trust, and that will just happen on an annual basis. And it will talk about all the income, capital gains that have occurred, any of these foreign offsets, these withholdings that you get overseas, and you'll get that. You can use that to file your taxes. So that was nice and quick and easy to explain. So it is not that complicated from a tax perspective to invest overseas. All right, let's see. In the current investment constraints, we need to focus. Oh, that's not a question. Sorry, there's lots of chat. No, Tony seems to just be talking about different things to buy. So I'll leave that to you, Tony. Battery materials. Yeah, that doesn't seem like a question. Okay, so Chris has a question. Can you confirm the difference between market cap of an ETF versus total assets? Yeah, so basically an ETF in general, an ETF will trade very, very close to the value of the assets in it. So there are mechanisms in place to try to keep the net value of the assets and the price close together. So the net value of the assets indicates what is the value of everything that it's holding. If it's holding 10 shares, what is the value of that? The price will relate to what it's actually trading for in the exchange. Now, market cap is a little bit different. So when we're looking at that NAV, that net asset value, and when we're looking at the price, we are looking at that on a per share basis. But the market cap of an ETF refers to not only that price, but also all of the shares outstanding. So it doesn't necessarily have much to do with what you need to worry about as an investor, unless you're kind of curious if an ETF is bigger than another ETF. So the market cap really represents how many investor funds in total are invested in that ETF, which is something that's nice to know. Allows you to make statements like Vanguard Australian Shares, ticker symbol VAS, is the biggest ETF in Australia. Why is it the biggest? It has the largest market cap. So those shares will keep getting introduced or reduced depending upon supply and demand of that ETF, but it basically shows you how much is invested in that. So if a market cap's $1 billion on an ETF, that means investors put $1 billion into that ETF. But that doesn't really have any impact on the price. That looking at the assets that are actually in there, yes, funds under management, as Rodney said. Looking at the asset value per share allows you to compare that to the price, and that actually has a little more of an impact because it impacts things like tracking error and things like that. All right. I think I got through most of the questions, and it's 2:00. So if anyone has any questions that I missed or has any statement on World War III that they would like to send me, my email address is mark.monica1@morningstar.com. So thank you very much for joining.
This video has been prepared for clients of Morningstar Australasia Proprietary Limited and or New Zealand wholesale clients of Morningstar Research Limited. Any general advice has been provided without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.